I often hear people using 3 words to describe what an auditor does. If you want to, you can pause the video now and ask the people around you, what does an auditor do? Go ahead, have fun. Is this the response you got? Well, yes, an auditor checks the account and ensures the figures in the accounts are accurate. But does an auditor only check the account? Do they have any other responsibilities? All entities that need to go through independent auditing will attach the independent auditor's report in its annual report. In the independent auditor's report, the auditor will state their responsibilities in performing their audit. By the way, when I say independent auditing, it means the auditing is performed by an external organization, not a staff within the organization. This is to avoid a conflict of interest, as an internal staff may be tempted to change the numbers to make it look favorable. An external party is less likely to face such conflict of interest. Let's look at some of the independent auditor's report to see what an auditor does.
SBS Transit is a public bus and train operator in Singapore. So now let's take a look at the auditor's report. So you will first see the audit opinion, where the auditor will specify whether or not in their opinion, the financial statement provide a true and fair view of the company's economic status. And right here, we can see the auditor's responsibilities. Let me just zoom this in. And you can see the auditor's objective is to obtain reasonable assurance about whether the financial statement as a whole are free from material misstatement. They are also required to identify and assess the risk of material misstatement, understand the company's internal control, evaluate the appropriateness of accounting policies used, and conclude on the appropriateness of going concern. Going concern refers to whether or not the company is able to pay its debts when they fall due. If the auditor noticed that the company may not be able to pay its debts when they fall due, in other words, facing a risk of financial failure, the auditor has to state this in the audit report. Here, the auditor also needs to evaluate the overall presentation, structure, and content of financial statements, as well as to obtain audit evidence relating to financial information of the entity. When it comes to a non-profit organization, like St. Andrew's Mission Hospital, the auditor has another responsibility. So let's take a look at the independent auditor's report. The auditor also have to report on legal and regulatory requirement, specifically the Charities Institution of Public Character Regulation when it comes to a non-profit organization.
Here's a summary of what we observe. So we can see an auditor does more than just checking the account. Must an auditor ensure the numbers in the financial statement are accurate to the dollars and cents? No. Quoting the auditor's report we saw earlier on, our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements. And material misstatements refer to misstatements that could individually or in the aggregate reasonably be expected to influence the economic decisions of users taken on the basis of these financial statements. This means if a person relying on the financial statements could make an incorrect decision because the numbers in the financial statements are inaccurate, the financial statement is materially misstated. If the financial statement contains some misstatement, but this misstatement would not cause a person relying on the financial statement to make an incorrect decision, the misstatement is not material. A public company needs to publish its annual report within 4 months from the financial year end. It is not possible for an auditor to check the accuracy of all transactions occurring in a year within 4 months. Materiality is something subjective. Most auditors, however, will use the following benchmark: 10% multiplied by the normalized net profit before tax. When I say normalized, please note that we will exclude the effect of one-off gains or losses. One-off gains or losses are those that occur outside the entity's principal activity. It occurs infrequently, so the effect is excluded because such one-off gains or losses are not expected to happen again. If the net profit before tax is 1 million and the company suffered a one-off loss of $100,000, the normalized net profit before tax will be the net profit plus the one-off loss, giving us 1.1 million. We will then take 10% of the normalized net profit before tax to get a materiality threshold of $110,000. At the end of the audit, the auditor will calculate the net effect of misstatements on the net profit. If the net effect of misstatements on the net profit exceed $110,000, the misstatement is deemed material. Is it possible that an auditor will fail to detect material misstatements? The answer is yes. We noted earlier on that the auditor's objective is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement. Reasonable assurance is a high level of assurance, but it's not a guarantee that an audit conducted in accordance with the Singapore Standards of Auditing will always detect a material misstatement when it exists. This brings us to the concept of audit risk, which is the possibility that an auditor fails to detect material misstatements when it exists. Audit risk is influenced by three factors: inherent risk, control risk, and detection risk. Inherent risk refer to the risk of material misstatement that occur naturally within the account. Some accounts are naturally prone to misstatements, such as those whose value fluctuate all the time. Control risk is the likelihood that a misstatement will occur because of internal control loopholes. Internal control are designed to ensure that transactions are recorded accurately. A poorly designed internal control increases the risk that a transaction will be recorded inaccurately or not even recorded at all. Detection risk refer to the risk that the work performed by the auditor will not uncover any misstatement. The risk of material misstatement is the inherent risk and control risk combined. Inherent risk and control risk are beyond the auditor's control. Therefore, to minimize audit risk, the auditor will minimize its detection risk by performing more extensive work. The auditor could also collect better quality audit evidence which will help uncover misstatements more easily. The auditor should collect reliable audit evidence if it wants to minimize the detection risk. An auditor can gather evidence from internal parties and external parties. External parties is more reliable. This is because if a company wants to manipulate the accounts, it may manipulate all its documents and submit a manipulated document to the auditor. An external party has no reason to manipulate or purposely give false information to the auditor, since they are independent of the company. Next, between original document and photocopied, fax or email document, which is more reliable? It will be the original documents, because the document could be manipulated while in the process of being photocopied, faxed or emailed. When presented with verbal information and documented information, this should be pretty intuitive. Documented information is definitely more reliable because you can always verify a documented information. How do we know if the figures in the financial statements are correct? For balance sheet items, an auditor will look out for 4 assertions: existence, completeness, rights and obligation, and valuation and allocation. When an auditor addresses an item's existence, he needs to check if the item exists at the end of the financial period. When it comes to completeness, the auditor needs to ensure all items that should be recorded in the balance sheet are recorded. There should not be any items omitted from the balance sheet. Rights refer to whether an entity owns an asset, and obligation refers to whether the entity is held responsible to settle a liability. Some figures in the balance sheet require a lot of judgment, like provisions and the net book value of non-current assets. The auditor needs to assess if the items are carried at a reasonable value. When it comes to transaction-based item, meaning items from the income statement, statement of changes in equity, and cash flow statement, an auditor will look out for 6 assertions: occurrence, completeness, accuracy, cut-off, classification, and authorization. Transactions recorded in the financial statement must have occurred. The auditor also needs to ensure that all transactions that should be recorded are recorded. There should not be any unrecorded transactions. In determining the accuracy of the transaction, the auditor ought to assess if the amounts relating to the transaction are recorded at a reasonable value. A transaction occurring on 31st December 2019 should be recorded in the 2019 financial statement, and a transaction occurring on 1st January 2020 should be recorded in the 2020 financial statement. This is what cut-off refers to. When an entity made a sale, this should be recorded as sales in the income statement, and when the entity received cash from the customer, this should be recorded as cash received from customer under the cash flow statement. Such transactions must be recorded and classified correctly. Authorization focuses more on internal controls. Before a transaction occurs, it should be properly authorized according to the internal controls. A good authorization process will minimize the risk of misstatements and even fraud.